Hey everyone, it's Mikey Millions here. In this video, we are going to talk about a defensive options trading technique that I probably should have covered well over a year ago. We are going to talk about rolling your options. This is a particularly important maneuver if you use the wheel strategy. And since I think the wheel is where most Theta Gang traders start, learning how to roll is critical.
And as we get started, I'd like to thank my friend and Lancer of House Theta, Firenance, for sponsoring this video, for which I'll be compensated a cut of his merch profits. We'll get back to that later. For now, let's do some rolling.
When life starts going against you, do you just say, well, I've been sucking ass so far, might as well keep sucking ass? Hopefully you don't. You flip your game to get back on track. The same applies to trading. If things are not going according to plan, you'll want to perform a defensive maneuver to salvage your trade. Rolling is the easiest and most flexible technique to get your trade back in order. Let's demonstrate what it is and how to use it. Let's say you decided to wheel WallStreetBets. So you started with the classic move of selling a cash secured, aka cash covered put. The stock was trading for about $25 last week. So let's say you sold the $25 put expiring 2 weeks out for $100 premium. You're rooting for WallStreetBets to finish above 25, and your break even is 24. So you really need WallStreetBets to stay above 24, or else you'll be assigned at a loss to start your wheel. Well, sure enough, things didn't go according to plan, and here we are on expiration day with WallStreetBets trading at only $23. We are a full dollar below our break even, and our loss is $100 so far. Our basis will be $24 on assignment, so we are in the hole. What's the plan here? Well, if you're fine getting assigned on WSB, you could just go ahead and take the assignment with a $24 basis, no problem, sell a covered call at the $25 strike, expiring in 30 days for $100 premium, spin your wheel, yada yada. If you're bullish on WallStreetBets, that's probably what you should do. But what if over the last 2 weeks while this cash secured put was open, your opinion on WallStreetBets got more bearish? The stock isn't doing so hot right now, and you're not sure if you want to start a wheel at a $24 basis after all. Can we do something to get our basis lower before we face assignment? We can. We are going to sacrifice time in exchange for money by rolling out our short put to a different strike and different expiration. By doing that, we can keep this trade open longer rather than face assignment now, and we can start our wheel with a more favorable basis.
Before we get into specifics and talk about some real-life examples of how I use rolling, let's do the sponsored segment. This segment ends at the 4-minute mark, so if you're not interested in seeing my homeboys merch, skip to the next chapter and we'll get back to rolling. But I recommend you stick around, because the memes I'm about to bring you are the kind that make you spit your coffee. So Firenance failed to pull out back in Q1 and later realized that having a baby is straight up RIP to his bank account and mental health. So in preparation for the arrival of Firenance Jr., Homie neglected to decorate the nursery and instead prepared a white-hot merch store. His merch store brings comfy clothes, good fits, and if you're a real rebel, some phrases that might break your high school's dress code. Firenance sent me a sample hoodie and beanie, so now I am prepared to rob a bank this winter in style. Are you a student? We've got backpacks. Are you a Slav? We've got tracksuits. Are you the Rush chair of Kappa Apple Pie? We've got things written in Greek. And are you one of the 8 women that watch my videos? We've got clothes that basically guarantee you'll get hit on, even without makeup. Check out Firenance's swag shop, link in the description below, and use promo code Mikey10 for a 10% discount. Thank you again, Firenance, for sponsoring this video, and finally making us some decent gear. And now, let's get back to rolling.
Rolling is a simple 2-step process. We will first buy back our WSB short put for a loss, and then in the same trade, we will sell a new short put for more than we just spent to buy back our initial short put. In our WSB example, this means opening the options chain and buying back our $25 put for $200. Since we collected $100 for selling this put initially, we are locking in a $100 loss. But next, we are going to roll out in time, so let's select an expiration 5 weeks from now and sell a new put for more than $200. The stock is trading for $23, so let's sell this $23 put for $210. As we go to execute, notice that we are actually grabbing an extra $10 of premium here, and also lowering our strike by $2. In exchange for these advantages, we are now committed to holding a put that expires in 5 weeks. We have traded 5 weeks of our time in exchange for collecting a little extra premium and lowering our basis if ultimately assigned. Since we collected some extra premium when we rolled, this is called rolling for a credit. If we end up having to sell the new contract for less than the old contract, we're basically paying to roll, and that's called rolling for a debit, which is much worse. But if we go ahead with our new trade here, what is our new break even? Well, your first instinct might be to say, my strike is 23 and I collected $210 premium, so my break even must be $20.90, right? Well, not quite. Remember that we locked in a $100 loss when we rolled that initial short put. So we must subtract that loss from the premium we got when we sold the new put. After we adjust for that loss, our new break even is actually $21.90. If for any reason it is important to you to lower your basis before taking assignment, this is the way to do it. Perhaps you're just selling puts on margin rather than actually wheeling, so you want to avoid assignment wherever possible. And this is exactly what I do with Tesla frequently. If you follow me on Patreon, you'll know that I sell out of the money puts on Tesla, or sometimes LRCX, to collect premium. I do not have $60,000 cash to cover assignment. I am using my margin allowance as collateral, so I prefer to avoid assignment whenever possible. When things go well, Tesla stays above my short put, and I collect a few $1,000s. But when Elon tweets something stupid and Tesla drops below my strike, I usually look to roll. To do so, I just buy back my short put for a loss, and then roll out to a later date where options premiums are higher, and I sell a new short put to recoup the loss plus some, and also lower my strike price. Having this maneuver in my pocket gives me the confidence to trade a high volatility stock like Tesla, and it would also save me if Tesla really did tank. Keep in mind we can roll for many more reasons than just dodging assignment on short puts. We can also roll short calls like covered calls. If you sell a covered call on WallStreetBets at the $25 strike, but the stock goes up to 27, then typically by rolling out in time, we can increase our short strike to $27 or above. We can also roll undefined risk strategies like short strangles. If you sell a $23 by $27 short strangle on WallStreetBets and the stock rises to 29 bucks, we can roll up our $23 put to the $27 strike and turn this short strangle into a short straddle. This allows us to collect additional premium and expand our break even, most likely past $29. There are many reasons to roll, and I encourage you to look for opportunities to do so when a trade goes against you. Now that we understand how to roll and what it does for us, let's talk about some of the best practices so that we are rolling effectively and not just making a mess out of things. First, remember that you don't have to roll if you're about to get assigned. In order to roll your new strike to the stock's current price, you might need to sacrifice a significant amount of time, as in months, in order to do so for a credit. You may be better off taking assignment and continuing to wheel as usual, rather than roll out in time. This is especially true if you're on a cash account. 2, it is not necessary or even desirable to wait until expiration day to roll. If you sell a covered call and the stock keeps rising and rising beyond your strike, then you'll be deep in the money on expiration day. It is very, very difficult to roll out deep in the money strikes out to new at the money strikes. Sometimes it's just not feasible to roll at that point. To avoid this, consider rolling well before expiration, preferably when your break even is first getting tested. Again, only if you want to roll. You don't have to. 3, it is indeed possible to roll pretty much forever if you really want to. Even if you're deep in the money, buying back a covered call expiring tomorrow and selling a covered call at the same strike expiring in 8 weeks will almost always give you some credit and help you avoid assignment. That doesn't mean it's a good idea. I sold a QQQ covered call at the 185 strike during the COVID crash of 2020. Over the next 12 months, QQQ kept rising and never looked back. I tried to continue rolling this thing, but it was a waste. There was such little extrinsic value on my deep in the money covered calls that it was almost impossible to roll up my strike. I had 100 shares giving me 100 delta, and an in the money short call taking back 99 delta. For the $35,000 I had tied up in QQQ shares, I was getting 1 delta. Huge waste of buying power. I strongly recommend that you avoid this by cutting your losses if you wind up with a 200% loss, rather than trying to roll forever. I ended up taking assignment on that covered call and using the cash to buy back some of the shares, in case you're curious. And finally, remember that every time you roll, you're closing a trade on that first contract. If you're buying back that first contract for a capital loss, that's a tax write-off. If you're buying it back at a gain, you're going to owe tax. And if you're rolling an in-the-money strike to another in-the-money strike, that could be a wash sale. To avoid wash sales, make sure you always roll to at-the-money or out-of-the-money strikes. The rules are a little ambiguous, and I'm not an accountant, but those are the generally accepted practices of wash sales when rolling. If you have any questions, call your cousin Vinny and he'll help you out. If you want more information on rolling, Investopedia and Tasty Trade are great resources. When it comes to rolling Theta Gang strategies, I've also written a handful of Patreon posts on the topic that you might find useful. Link in the description, of course. Alright guys, that's it for this video. I encourage you to experiment responsibly with rolling and discover where it can benefit your trading approach. Thanks for watching, and I'll see you guys next time.